What's up, Toasters? This is the Toasty Podcast, or Toasty Money, however you want to say it. I'm Sky Day, and I go over a different investing topic every week to help the average Joe like me. Last time I did this was, probably more than a week ago, and you would think that during this time I would have all the time in the world to stay at home and make these podcasts for you guys. Unfortunately, that's just not the case. I work a day job that's still going strong. I'm a service writer at BMW, so apparently people with BMWs still need their cars fixed. Imagine that. Today I want to talk a little bit about the trading orders that I talked about last time, but a little bit more in depth. So let's just get to it, and let's get toasty. So last time on this podcast, I talked about market orders, limit orders, and gave you guys a little bit of the rundown on that. Now I want to expand it. Let's get serious, huh? Get a little bit more involved. Maybe take the next step in our trade order relationship. So the next thing we're going to talk about are stop loss orders. Maybe I touched on it, maybe I didn't. I can't really remember. And stop limits. The thing is that stop losses are, they're also referred to as the stopped market, on stop buy or on stop sell. It's funny. I don't really refer to these. I think that's like old timers that would say that kind of stuff. Stop loss is pretty much the term everyone uses now. It's one of the most useful orders. Why? Because unlike the limit and the market orders, which are active as soon as they are entered, this order remains dormant until a certain price has passed, at which time it turns into a market order, right? So the idea here is that you have a price you want to set it at, and you really want it to go for that price, but you also don't want to miss it. Like we talked about last time, some orders don't get filled if they're placed at a uncertain time, like when a crash happens. It just skips past you. Sorry, buddy, not going to happen. As for market orders, they are always filled, almost no matter what, but you may not get the price you ask for. So a stop loss is set, and if it gets to that price, it then becomes the market order. So you'll get it filled. No doubt. And when you're losing tens of percentages, so 10, 20, 30% on your portfolio in a quick amount of time, this will save your butt. Moving on, keep it lightly toasted. Stop limit orders are similar, but they don't have the market order at the end of them. They have a limit order at the end. Okay? So it'll go at the price you set, it'll set up the stop. And it will convert it to a sell order at the limit price. Instead of the order becoming a market order to sell, the sell order becomes a limit order, and it will only execute at the limit price or better. I guess it can filter out some potential problems with stop loss orders, which might be triggered during flash crashes that return very quickly. There's always a situation for everything. That's why I can't tell you which order to use. You have to do that. The main thing I wanted to get out of this podcast today is the trailing stop or the trailing limit orders. I didn't touch on these very much at all, I don't think, in my last episode, and these are necessary. Actually, probably the most necessary ones of them all. They're the ones that I will push the most for sure. The thing about this trailing is, the name implies, just like most of these, the name implies it, okay? But you don't always want to think that, it's exactly what the name implies in the stock market, because what if you're wrong and you lose money? So I'm going to put it to an end right here and tell you it is definitely what the name implies. A trailing stop loss is it will trail a certain percentage or a certain amount of money less than the market order you have on it. So if I order the stock and then I have the stock in my possession, excuse me, I've already had the order placed for the buy. So now I'll just have to sell to end the trade, right? Instead of waiting for that amount of money to hit or that price to hit and then putting the order in at that time, put a trailing stop on it immediately after you buy the stock. This trailing stop is going to be for out of your portfolio, let's say one stock out of it can't get less than 10%. And let's put that trailing stop at 10% below the price that it is now. Now, where this fails is flash crashes, just like the stop loss order. This is essentially the same type of order, but it trails the stock as it soars to stardom, or in worst case scenario, fails and you lose 10%. But what gives? 10% is, gosh dang it, I have a freaking flies in here. What the heck? I'm indoors, man. 10% is a lot better than the 15 or the 20 that you could lose in other areas at other times whenever stocks are falling. In your portfolio, you might be dealing with that right now. This has been one of the worst times since 2008. Everyone's saying whatever, probably longer than that. Don't listen to them. It is bad if you did not do any selling beforehand and you didn't have a stop loss in place and you didn't have a trailing stop in place and you're just the worst trader. Oh my gosh, what are you going to do? You're going to relax and you're going to keep what you have and don't sell low. We don't do that. Buy high, sell low is not the motto for any trader. Buy low, sell high. Now that's something I can get behind. So when you're placing that order and you don't know what to do, you just gotta think about the future. Don't think about now. Don't think about where we're at in the market now. It won't stay this way. It's just not how it works. So when you're looking at a fair value stock, which honestly, almost all of them right now are fair value. I cannot say fair value. And so look at those and get them, please. The next thing that's been on my mind lately are dividends. I don't talk about them. I actually don't know if I've talked about them at all on a stock. And right now is the time to talk about them because the stocks you want to buy that are always too expensive are now right for you. Apples of the world, the Googles of the world, the Amazons of the world, they all got hit just like every other stock. No company that has shareholders is immune to investors' feelings and moods and sentiments. None. So when every single stock in the stock market falls, they will also fall. It takes a second, but when they realize how stupid they're being, the investors will get behind it. The enterprise investors will get back on board. So we're about to have that happen, maybe, depending on how the coronavirus lets up or what happens to that. In the meantime, look at Apple, look at AT&T, look at the stocks that provide the dividends. McDonald's, Johnson & Johnson, PepsiCo. What else do we have here? General Dynamics, Accenture PLC, Exxon Mobil, and Chevron. You're thinking, you idiot, why would you be in oil right now? Well, now you're at a bottom, so you're good. If you've had it beforehand, all the stuff happened in Saudi Arabia against Russia with OPEC, you might be feeling pretty down right now, and I might be with you, but like I said, hold on through the storm. I'm going to be honest with you, some of my stocks in my portfolios did not, I say portfolios, because yes, there's multiple, did not hold up, and I did not have trailing stops on them. So guess where I'm at? I'm low. I'm at a loss. Just like the rest of you guys out there, I'm here with you through all of this. And trust me, I know that it'll be okay. Because I, fortunately, like to think that I know how the market might go. But you know what? You can't tell the future, so maybe not. So guys, that's just a little bit more on trade orders. I hope you got something out of this, and, well, if you didn't, whatever you do, stay toasty.